The Fed just raised interest rates to the highest levels in 15 years. So let's take a look at why they did it, what to expect in the coming year, what this means for the stock market, and why it might be good news for anyone that's looking to buy T-bills and I-bonds. How's it going, everybody? Welcome back to the channel. My name is Jay. Before we can get into all that, we first need to take a few seconds to understand what is the Fed. And the Fed is just short for the Federal Reserve, which is the central banking system here in the United States. And the Federal Reserve System is comprised of 12 reserve banks. But the part of the Fed that we are interested in here today is the Federal Reserve Board, which consists of 7 members and is currently headed up by Fed Chairman Jerome Powell. This board meets 8 times throughout the year, where they discuss economic conditions and try to develop a monetary policy that will both maximize employment and stabilize inflation. One of the most commonly used and effective tools that the Fed has in their arsenal to accomplish these goals is to increase or decrease the interest rates known as the Fed funds rate. They'll cut interest rates when they want to stimulate the economy and get money moving through the system, or they'll start to increase rates when they want to pump the brakes and slow things down. Which brings us to this week, where the Fed decided to raise interest rates by another 0.5% to a range of 4.25% to 4.5%. This is the highest the Fed interest rates have been in over 15 years. And the rate of increases we've seen lately is the most rapidly that rates have risen since the stagflation days of the early 1980s. If we look at some data points around the economy, we can begin to understand the bigger picture. Inflation numbers that came out earlier this week showed that inflation is slowing, the lowest month-over-month increase since December of 2021. But that doesn't mean inflation is in check, because overall rates are still high, at around 7.1% when we look at a year-over-year basis. So inflation is one of the things the Fed is trying to control, and the other is keeping employment high. While there have been some very big-name and high-profile companies that have announced job losses recently, unemployment rates are actually still pretty good. The most recent data that was released this month showed that payrolls grew faster than expected, with 263,000 jobs being added to the economy in November. Consumer spending measured through retail sales was up 1.3% last month, although no joke, right after I started recording this video, I got an alert on my phone. New retail data was just announced for November, showing that retail sales dropped by 0.6% in the month of November. So up 1.3% in October, down a little over 0.5% in November. But overall, the trends throughout the year are looking like inflation really isn't slowing down people from spending money and shopping just yet. We'll have to see how that plays out this month, as we can expect a lot of holiday shopping to occur. So what does this all mean? Where are we headed? What do these interest rates mean for our investments? And the first thing we have to keep in mind is it looks like we're going to be in a sustained period of high interest rates. The Fed just stated themselves when they announced this latest increase that they're targeting a peak interest rate of around 5.1% sometime in 2023, and they don't expect to be lowering rates from that point until sometime in 2024 at the earliest. So high rates are here to stay, at least for the next 12 or so months. In the news that high rates are going to stick around isn't really a change from what the Fed has been saying all year long. So while the stock market may react sharply one way or the other here in the day or two following the announcement, I think the overall trend isn't going to really change things. With stocks being down close to 30% on the year, I still believe it's a great time to be dollar cost averaging into index funds or buying quality companies with solid, sustainable profits. If you're the type of person that likes to invest in really high growth companies, you're gonna have a hard time of it. Because those high growth companies, a lot of the time, are unprofitable and rely on borrowing to fuel their growth. High interest rates are really gonna make things rough for them over the next 12 to 18 months. And like we just mentioned, while inflation is still high, the rate of inflation is slowing on a month-to-month basis. So I wouldn't be surprised to see the variable portion of the I-bond interest rate dip again at the next adjustment period. However, currently I-bonds have a 0.4% fixed interest rate attached to them, giving your I-bonds nearly 0.5% boost above inflation for the life of the bond. That rate too may adjust higher at the next period, but that is far from a guarantee. So if you were planning on loading up and maxing out your I-bonds again in 2023 when the new year changes, just keep in mind we may see a declining variable rate on those bonds but that fixed rate may still make it worthwhile over the long term. And the news that interest rates are going to remain high and possibly stay there for the next 12 to 18 months means that you can probably expect investments like T-bills and other short-term treasury bonds to continue to have quite attractive interest rates. In fact, if you're doing something like building a T-bill ladder, you might be even more comfortable throwing in some longer maturity dates into that ladder, seeing as the Fed has said they're aiming for a peak of around 5.1% for the interest rate, and currently we're sitting at somewhere around 4.5%. So we're really not too far off from the targeted peak, so you're not likely to face a lot of interest rate risk on those longer term T-bills or even treasury notes. That is, unless the Fed decides to drastically change course in one of their next meetings. Your guess is as good as mine on if something like that'll happen, but in the meantime, all we can do is work with the information they've given us and what we're seeing in the economy. Let me know if you like these current events type videos by hitting the like button down below or giving me a comment on this video, and I'll plan to keep doing more of them or never do one again based on your feedback. Thanks for watching, and I'll see you next time.